Good evening and welcome to the T. Rowe Price Internet Seminar. I think they call them webinars these days, which is a new word to me. This evening I'm going to talk about the implications of the Ascent of Money, my recent television series for Channel 13 and book for Penguin Books, for your situation today as the US economy grapples with what has been the biggest financial and economic crisis since the early 1930s. What are the prospects for recovery? What are the dangers that lie ahead? How can you deal with what appears to be the descent of money? I'm going to begin by offering you a few thoughts about where I think we are, and then I'm going to take some of the questions that you have sent me over the internet. Let's just begin by reflecting on where we are. We have just missed, by about 3 inches, a Great Depression. If you look at the way the world economy behaved between 1929 and 1931, and compare it with the way the world economy has behaved since 2007, the resemblances are truly uncanny. Take world output, it's declined by almost as much as it did in the first phase of the Great Depression. If you look at world trade, in fact, it's even worse. And if you look at the way in which jobs have been destroyed, there really has been nothing like this since the first phase of the Great Depression. But in the last few months, since the summer, we have seen a deviation from that alarming historical pattern. Think of the stock market, which in the Depression continued its nose dive from 1931 onwards into 1933, but which in the last months, since I guess March or April, has seen a remarkable rally. We've seen in the most recent quarterly numbers to be published by the United States for the third quarter of 2009, positive growth, an end, at least technically, to the recession. So can we all breathe a sigh of relief and conclude that we've escaped from Great Depression 2.0? Have we avoided the nightmare scenario? That's a question I think on the minds of a great many people tuning in now. Well, here's the way I see it. We have avoided the Great Depression by learning from history. If you look at monetary policy, if you look at fiscal policy, look at the way in which the Federal Reserve and the US government has responded, look also at the way that European governments responded to this crisis, and it's clear we've avoided the mistakes of the early 1930s. Back in the 30s, governments responded to the crisis by raising taxes and cutting spending. Back in the early 1930s, central banks responded to the crisis by tightening credit and actually, in some cases, raising interest rates. Well, we didn't do that this time around. Ben Bernanke roughly doubled the monetary base, that's to say the balance sheet of the Federal Reserve, gave a massive injection of what economists like to call high-powered money into the economy. And at the same time, the US government has been running the biggest fiscal stimulus in the form of huge deficits seen since World War II. The most recent deficit, $1.4 trillion, I think was the final score, comes in at somewhere in the neighborhood of 11% of gross domestic product. Well, we haven't seen a deficit that large since the 1940s. In fact, the deficit was about that size in the year after Pearl Harbor in 1942. So we are combating this depression, or near depression, with monetary and fiscal methods you would more associate with a world war than with peacetime. And it's working a bit. I say working a bit because although we've clearly avoided an entire repetition of what happened in the early 30s, massive bank failures, unemployment of 25% compared with 10% today, we've avoided that nightmare scenario so far, but there are problems ahead. Let's just look at the fiscal consequences of fiscal stimulus. $787 billion was the stimulus bill, but that came on top of an already huge deficit. And if you look ahead, not just at 2009, a fiscal year that's just ended, look ahead to 2010 and beyond, the really striking thing is that the US federal government seems to be addicted to deficits. The deficit next year is forecast by the Congressional Budget Office to be something like 10% of gross domestic product. It doesn't come down that much the year after. And in fact, if you look ahead, taking the CBO's numbers, right into the 2030s, there isn't a single year that they foresee in which the US comes remotely close to having a balanced budget. In fact, the deficit will go down to about 3% of GDP if the CBO's figures are right, and then start rising again after about 10 years. Now, that is a recipe, it seems to me, for fiscal crisis at some point or another. Because you have to ask yourself, how much can we justify that kind of borrowing after some kind of recovery has set in? Let's face it, these are figures based on the assumption that the economy will recover, that we will return to growth at least in the region of 2.5% to 3% a year. And yet the deficits continue. Long after the threat of depression, we're still running up the red ink. My question, and it's the question I think most about right now, is who buys the bonds? If the US government is going to issue more than $1 trillion of new debt every year, as far as the eye can see, for the foreseeable future, until the end of my life and beyond, then I am quite curious to know who's going to buy all these bonds. Now, when I argue with economists, particularly of a Keynesian persuasion, those who've studied the works of John Maynard Keynes, they always tell me it's fine because the US savings rate has to go up and American savers will be very happy to own US government bonds. And so will these banks that got into such terrible trouble in the financial crisis. They want to play safe, and instead of lending to people who want to buy cheap or rather expensive subprime housing, they'll want to lend to the US government. However, when you do a little bit of arithmetic about this kind of thing, it's a little unpersuasive. Morgan Stanley, not that one should necessarily believe everything that investment bankers say, but Morgan Stanley have done some calculations, and they come up with a shortfall of somewhere in the region of $600 billion, trying to work out how much it's credible to expect households and banks and the Federal Reserve and, of course, foreigners to buy from the US government in the form of bonds. Who is going to make up the difference? Where are we going to find buyers for this additional $600 billion? That's a really, really important question. Why? Well, the two most plausible candidates for picking up this rather substantial tab are the Federal Reserve and foreign governments, in particular the government of the People's Republic of China. That creates two possible scenarios, if you want to think of it that way. In one, the Fed prints money. Essentially, it takes treasuries, it takes government bonds and exchanges them for good old greenbacks. And the supply of money just keeps on growing. For some economists, like, for example, my colleague Ken Rogoff at Harvard, that's a recipe at some point in the future for inflation. I must say, I find it hard to picture us getting to inflation anytime soon, though. After all, there are huge deflationary forces at work in the world economy right now. Consumers are not rushing out to the stores. I'll be surprised if there's really much of a frenzy in the post-Thanksgiving sales. And that's partly because they have these very painful debts hanging over them. 25% of US homeowners are in negative equity, are underwater, because their debts are worth more than the houses that they bought with the mortgage. And that's a reason why I don't expect to see a rapid bounce back of the US economy. And with unemployment above 10% and likely to stay there, it's hard to see where inflation is going to come from anytime soon. The other scenario, which I think we need to give serious thought to, is one in which we rely increasingly on foreigners to finance our deficit. Now, they already hold nearly half of all the federal debt that is not in the hands of government agencies, of US government agencies. And that's really rather a disturbing thought, isn't it? That half the federal debt's in foreign hands, and of that, a really large chunk, maybe as much as 10 or possibly even more than 10%, is in the hands of the People's Republic of China and its central bank and foreign currency agency. What an extraordinary state of affairs. And the big question is, well, will they continue to buy? And what would induce them to take on even more US government debt? It's already, after all, close to $2 trillion that they hold in their foreign currency reserves, mostly in the form of dollar-denominated bonds. And if we want them to carry on making this trade and perhaps ending up with 3 or 4 or, well, when will it stop? 5, 6, $7 trillion? what's in it for them? From the Chinese point of view, this is a pretty risky trade. They are long the dollar as no one has ever been before, at least in the international investment community. And that's why recently we've heard so much complaint, not least when the president himself visited China, about US monetary and fiscal policy. The Chinese are nervous. They feel uneasy about the way in which we're behaving and the amount that they have already lent us. Of course, it suits them very well to continue to intervene in the international currency market to keep their currency weak. That means by buying dollars and thereby financing our borrowing, because that keeps their exports cheap. And that really is the key to understanding what I call, in the Ascent of Money, Chimerica, that strange fusion between China and America. But if there comes a point when the Chinese decide it's safe to let their currency appreciate, that they can stop the Chimerican trade where they buy dollars and we go shopping, well, then we'll be into very interesting territory indeed. And here's why. At the moment that the Chinese stop accumulating dollars in the way that they have done for the last 5 or 10 years, we're likely to see at least some softening in the market for US government bonds. That means the price of bonds will fall. That means the yield on the bonds, which is the long-term interest rate, is likely to move up. Not by much, perhaps, but enough to raise nominal rates, not only for the US government, but for everybody with a mortgage or trying to renew or take out a new mortgage in the United States. This is the prospect that I find most troubling, the possibility of a slight upward movement in nominal rates, which might be combined with lower than expected inflation, possibly even deflation. After all, if you look at headline inflation right now, it's in negative territory. This is what economists call a rising real interest rate. The real interest rate is just the interest rate you see on your statement minus the inflation rate. That's the real rate that you're paying. Now, if the real interest rate goes up, whether because nominal rates rise or inflation falls, that's pretty bad news if you have a large stock of debt. And that's the situation not only of the US government, but remember, of the US economy as a whole. Take households, take financial institutions, take corporations, add them together with the public debt, and you end up with a debt to GDP ratio of 350%. I find it hard as a financial historian to see any examples in past history of a society this indebted. So, although many people fear that we're going to end up with an inflationary solution to our problem of a massive overhang of debt, my worry is that we might be ground down by rising real interest rates. And if I'm right, then the prospects for economic recovery are really rather gloomy, because it's hard to grow under a mountain of debt. Well, on that not terribly cheerful note, I'm going to start taking some of the questions that you've been sending in to me today. I'm going to be checking the screen here for the latest questions to come in, and I'm also going to look back at some of the questions that we received earlier today in anticipation of this evening's webinar. I'm going to begin with a question from Dale Miller, who asks, what are the root causes of the most severe economic crisis in the United States since the Great Depression? What changes need to be put in place to avoid a similar crisis in the future? Well, in the Ascent of Money, I tried to come up with a 6-part answer to the question, what caused this crisis, by going all the way back in financial history and explaining where our financial system came from. I try to show what had gone wrong with the system in recent years to cause the crisis to happen. Bear in mind, Dale, that I wrote the book and scripted the television series before the crisis began. It was all dreamt up and largely executed in 2006 and early 2007. So I think I can say with some confidence that I was one of a relatively small number of people who called this about right and saw that there was likely to be first a liquidity crisis and then a massive financial crisis and then potentially a near depression. My 6-part answer I'll give you in super abbreviated form, since this is a webinar and not a Harvard lecture. Number 1, excessive leverage on bank balance sheets. US banks just got way too reliant on debt, borrowing from one another, borrowing short-term from the commercial paper market, borrowing any way they could, in order to increase the ratio of their balance sheet, that's the assets, to their capital. That was a way of getting a high return on capital, and that was the way to propel your stock upwards and doubtless also your stock options if you were a CEO or other senior executive of the bank. So excessive leverage that saw investment banks with balance sheets roughly 30 times their underlying equity capital. It got even higher in the case of some commercial banks. If you look at Citigroup, it got as leveraged as 50 to 1, even higher in the final phase of the bubble before the crisis really struck. So that's part one of my answer. Part two of the answer is the contamination of the bond market by AAA rated toxic waste. Here, I think we need to look closely at the way that a whole bunch of structured financial products, collateralized debt obligations, for example, that's to say, strange securities that were based ultimately on the collateral of subprime mortgages, how these weird things came to have a AAA rating. At the height of the crisis, there were 12 corporations in the entire world with a AAA rating, and there were 64,000 structured financial products. Now, it turns out that they should never have had those ratings. Some of these things are worth 23 cents on the dollar today. AAA, I don't think so. This was junk. But, you know, we need to ask what went wrong in the rating process. Part three of the answer is I think there was a fatal mistake of monetary policy by the Fed, particularly in the years 2002 to 2004. And I think we can see that that arose because of a flawed belief, an erroneous argument that the central bankers made that they didn't need to worry about asset prices. All they needed to do was to worry about consumer price inflation. Well, that led, I think, to a disastrous miscalculation. The federal funds rate remained extremely low in 2002-2004, while property prices in the US were going crazy, rising at an annual rate of, well, 18% by the time the bubble really got going. Part four, well, the system of insurance went insane. You had the biggest insurer in the world, AIG, selling insurance policies against financial crisis, credit default swaps. You know, how can you possibly calculate the probability that an investment bank is going to go bust, which of course is what happened in 2008 to Lehman Brothers? Well, AIG was selling insurance against this kind of risk the way you would sell insurance against automobile accidents or holidays cancelled due to illness. And my point in the Ascent of Money is that you just can't treat those risks as the same. Financial risk is not like the risk of an automobile accident or the risk, for that matter, of a hurricane in the Caribbean. We just don't have the ability to attach good probabilities to those risks. And by selling insurance against financial risk at what turned out to be crazy prices, AIG blew itself up and very nearly blew the entire financial system up with it. Part five, well, of course, how could I explain the crisis without real estate? And the subprime story is in many ways a story of political error. We can't blame all of this on the bankers. We have to recognize that Democrats and Republicans alike were pushing the idea of increased home ownership and using all kinds of incentives to get people to buy homes, to take out mortgages, who really had no business doing that, who were not financially secure enough to be taking on the kind of mortgages that they were being sold. So the property-owning democracy blew itself up as we pushed the rate of home ownership up towards 70% of all households. Last but not least, I already mentioned it, China. You can't have a bubble like we had in 2006, 2007 without somebody injecting a lot of liquidity from outside into your economy. And the Chinese policy that I talked about a moment ago of reserve accumulation pushed interest rates down at the long end, and that meant also mortgage rates, by perhaps as much as 200 basis points, by maybe 2%. If it hadn't been for the Chimerica credit line, I don't think the bubble in real estate would have inflated the way it did. Well, that's about as short an answer as I can give you, Dale, to the question, what caused this crisis? You asked a supplementary question, and that was, what can we do about it? Well, we could correct these things. We could reduce bank leverage. We could regulate banks in a way that really reduced their incentive to get this highly geared. We need to look hard at the role the rating agencies played. Clearly something went wrong that encouraged a gaming of the system. I mean, 64,000 AAA-rated CDOs and mortgage-backed securities? Come on. I think we need to look at the monetary policy of the Fed. I think the theory of the Fed went crazily wrong, and we need to reassess the basis for monetary policy and get away from this nutty idea that all you have to do is anchor expectations of core consumer price inflation. It is much more difficult than that to be a central banker. Sorry, Ben Bernanke. Part 4, well, insurance. I think we really need to look very hard at the derivatives market and the way not only AIG but a bunch of other players were able to play what amounted to a kind of doomsday game with the financial system. Exchange-traded derivatives have to be preferable to over-the-counter derivatives. I'm not against derivatives altogether, don't get me wrong. Credit default swaps are not a bad idea. But the way in which this market exploded, allowing, in effect, the biggest casino in the world to take place, caused the Bank for International Settlements disquiet well before the crisis, and I sometimes felt I was about the only person paying any serious attention to their report. So I think there has to be some kind of reform of the way in which derivatives are traded. And finally, let's not forget real estate. There needs to be, and this I suspect is what the Consumer Protection Agency will do, there needs to be better monitoring of the way that products like teaser mortgages with adjustable rates are sold to financially pretty ignorant people. In parenthesis, let's face it, a little bit of financial education wouldn't do any harm, would it? That's something we've sadly neglected, not only in the United States, but in Europe too. And last but not least, I think this question of China's exchange rate needs to be addressed, and addressed more aggressively than it has been, because as long as the Chinese are able to distort international currency markets, there are going to be bubbles, there are going to be distortions. There, well, that was a staggeringly long answer. If I do answers that long for the rest of the evening, I'm not going to answer many questions. So here's another that follows on from that. This is from McLuhan. It's about China. If China dropped its dollar peg, what would this do to the USA's role in the global economy, energy supply markets, major trading arrangements, and other relevant areas? Well, there's a nice, easy question for a jet-lagged historian. Just to give you some background, China introduced a peg to the dollar, that's to say fixed the exchange rate of the renminbi in terms of dollars, some years ago now. Briefly allowed the renminbi to appreciate in the 2 or 3 years before the crisis. And then when the crisis really flamed up in 2008, restored the peg at a slightly, but only slightly, higher rate. I think any economist who's looked at this seriously, and it's one of the subjects that I do look at seriously with my friend Moritz Schilaric, will agree that this is a seriously undervalued currency, and that if you had a free market, the Chinese renminbi would appreciate by perhaps as much as 20 or 30% relative to the dollar. And I think we all agree that it's a little hard to justify this artificial weakness of the Chinese currency, given how competitive Chinese manufacturers are already in terms of productivity and unit labour costs. Out there in world markets, they would still be cleaning the clocks of their rivals, even with a stronger currency. So what's the follow-through? What happens if this argument finally is won? What happens if the Chinese do appreciate their currency and break the dollar peg? Well, as I mentioned earlier, one problem is that the US is therefore cut off from its cheap source of funding, which was Chinese reserve accumulation. But the upside is that the US gets at last some kind of competitive edge in its trade with China. Chinese goods would no longer be so spectacularly cheap for American buyers, and American exports would suddenly be just that bit more attractive to Chinese buyers. Now, it didn't used to matter that much, and China's share of US exports has historically been very low. But China's the fastest growing economy in the world right now. And essentially the US is excluded from serious trade with China by the dollar peg. My feeling is that the benefits of getting rid of that peg and moving towards a convertible Chinese currency are very real, that there would be benefits not only for the United States and for the rest of the world, which is currently being squeezed by the Chimerican marriage, the Chimerican couple, but I think it would actually be good for the Chinese themselves, who are really playing with fire like this and forgetting the lessons of history. In the period after 1945, the defeated Axis powers, Germany, Japan, experienced a remarkable economic recovery. Like China in the last 20 years, they pursued an export-led strategy, but they didn't follow the Chinese pattern of keeping their currencies artificially weak. In fact, the yen and the Deutschmark strengthened really quite remarkably in the period from the 1950s through to the 1970s. And the lesson's clear. You can allow your currency to strengthen without killing your exporters. The Germans did it, the Japanese did it, and I'm hoping that the Chinese will get around to doing it before too long. Let's now take a question from the hot list, from the top of the list. And here is a question that I am very attracted to from Michael Howe. Michael, what event or events would have to take place to transform the Federal Reserve's monetary base, which is at historically high levels, into serious inflation? Also, how close are we to the tipping point with respect to the US government spending and debt as a percentage of GDP? How serious is this issue? Why do you all want multiple questions? Well, Michael, this is a subject that I think about a lot. My PhD, after all, was in the German hyperinflation. So if there's one thing I think I know about, it's what causes inflation to surge. As you rightly say, Ben Bernanke has more than doubled the Fed's balance sheet. That's the high-powered money that is the basis for the entire monetary system. And a lot of people email me and say, does this mean hyperinflation is just around the corner? Are we headed for the Weimar German scenario? Well, not anytime soon is the answer. Because when you look at broader measures of money, look at M1 or look at M2, that includes the bank accounts, the current accounts where you keep your balances of cash that you take out of the ATM when you have to pay for something. If you look at those measures of money, they're growing much, much more slowly. That's because a thing called the money multiplier has fallen. That's the thing that relates the monetary base to broader measures of money. Even more strikingly, when you look at credit, which is in effect the other side of bank balance sheets, the loans that banks make, that's actually in negative territory. That is contracting right now. Now, you certainly can't have inflation if there's a contraction of credit going on. That's really, really hard to imagine. So the question is, what could change that? And I think it would be a very radical change in the way that people think. Expectations are the key. You can print money as a central banker until you're blue in the face. Japanese proved this in the 1990s. But if people don't believe there's going to be inflation, then there won't be. Expectations are the thing that translate an increase in the quantity of money into something that is actually inflationary. And right now, expectations of inflation in the United States are very stable. People seem to assume, this is based on survey data mainly, that inflation will stay in the 2 to 2.5% per annum range. I actually think that might turn out to be wrong. Inflation might come in lower, but there's not many signs out there of people expecting a big jump in inflation. The only sign of inflation fear that really impresses me is the surge in the price of gold. Now, if that's an indicator of inflation expectations, then we do have something to worry about, because people are running around the world buying up all the gold in sight, including the hedge fund supremo John Paulson, one of the few people to make serious money out of this financial crisis. But right now, I don't see inflation anytime soon. Take a longer perspective and, well, it's possible. Look at your second question, Michael, about the fiscal situation. If you look at the path of government deficits out over not just the next 5 or 10 years, look out over the next 30 years. It's a truly alarming picture. The Congressional Budget Office does two forecasts, two projections, one of a kind of base case and the other's what they call their alternative fiscal projection. And the alternative fiscal projection sees a debt-GDP ratio in the United States of more than 200% by the time I shuffle off this mortal coil, which I would guess will be in about 30 years' time, since I'm from Glasgow and lead a highly unhealthy lifestyle. In fact, perhaps I'll be lucky to get to 2039. 212% of GDP, remind you of anything? Well, that's pretty much where Japan is right now, on the way anyway, past 200%. And Japan has got up to 200% of GDP without the remotest sign of inflation. In fact, Japan is back in deflation this week. It was announced by the Japanese government, which makes you realize you can have a real old explosion of public debt without necessarily succumbing to inflation. The trouble is that historically, those sorts of debt burdens tend eventually to lead to inflation because they are so very burdensome. And from the point of view of debtors, there's nothing like inflation to reduce the real debt burden. Ken Rogoff's book with Carmen Reinhardt, which I recommend, This Time is Different, 8 Centuries of Financial Folly, makes it clear that a very common outcome of major debt crises is inflation. It's the timing that's so hard to nail down. And if you really want me to be specific about timing here, I would say we're not getting anywhere close to high inflation, and I'd say above 10% in the next 5, even 10 years. Beyond that time horizon, as the fiscal arithmetic gets uglier and uglier, who knows? It's possible. We've certainly seen it before. We saw it in the 1970s. If central banks print money and finance government deficits uncritically and without regard to what consumer prices and asset prices can do, then yeah, we could get back to inflation. But in the short term, that's not my big worry. And there's a follow-up question, just came in 20 minutes ago from Al. Good evening, Al. So, do you think the US will ever balance the budget? How? Well, I guess it has to eventually, because you can't really borrow $1 trillion every year forever, which is the current policy. But how? And when? It's hard to see it happening anytime soon. There's an unholy alliance, isn't there, in the US Congress between Republicans who love to cut taxes and Democrats who love to spend money. This alliance has been operational now for quite a long time. It goes right back to 2001 when the combination of tax cuts and expenditure on the war on terror, and also increased expenditure on what we could call, for the sake of simplicity, the American welfare state, sent the US back into the red for the first time in some years. And those deficits persisted even although the US economy was in fact booming in the mid-2000s. So there is a kind of coalition that's going to have to be broken between tax cutters and spenders. What I'm looking for are some politicians with the courage to say, this is unsustainable. This is going to get us into a Latin American situation. And the only way that we can avoid either a major debt crisis followed by default, whether it's default on Medicare or default on what we owe to foreigners, or, on the other side, some kind of inflationary nightmare where we print money until the debt is inflated away. The only way to avoid this is radical fiscal reform. What do I mean by that? Well, number one, I think there's going to have to be a new federal tax of some sort. And my suggestion would be a federal value-added tax, modeled on the kind of taxes that have been standard in Europe now for decades. Now, I can hear at least some of you groaning at the prospect of a new tax, but wait, I'm not finished, because I think you have to couple that new tax with reform of income tax. Let's simplify the tax code. It's a nightmare. For what is supposed to be the most dynamic economy on earth, the tax code is almost designed to promote economic inefficiency. Let's simplify it, the way many East European countries did after they freed themselves from communism. Let's have a flat rate income tax without all the complex exemptions that keep so many accountants busy at our expense. And let's reduce corporation tax, because corporation tax is really not a good tax at all. If people are being taxed on their income, taxing corporations as well is just a discouragement to capital formation. So my suggestion would be root and branch fiscal reform. If I'm right, that kind of reform, which I sketched with my friend Larry Kotlikov at Boston University back in 2004, that kind of reform would unleash growth in the US economy, would unleash the entrepreneurial energies. It would get this economy moving again. And once you get growth, well, once you get growth above a mediocre 2%, once you get up to 4%, you'd be amazed how quickly the deficit would disappear, just the way it did in the 1990s. So fiscal reform, please. And could we have some politicians who believe in balancing the budget, at least over a 10-year period? That would really, really help us. And I think it would help every American who's struggling today under a pile of debt, who is contemplating with despair the prospect of rising income tax and potentially rising other tax too. Okay, let me go back to my early question. I have to take one from Michael McMahon. because Michael is a countryman of mine. You probably gathered from my funny accent that I'm in fact not an American, but a Scotsman. And one way you can tell I'm a Scotsman is that I say the word book and food in a way that is perhaps a little unfamiliar. Michael, is this the beginning of the end of the era of Western global leadership and living standards? I feel unbridled greed is a root cause of our financial crisis. If so, what can the West do, if anything, to regain its leadership role? Great questions. The course I teach at Harvard right now is called Western Ascendancy, Mainsprings of Global Power, and it takes the story of global history back to the 1490s, when you would never have predicted Western dominance. Back in the 1490s, the biggest cities in the world were in Asia, or for that matter, in Central America. And if you'd gone to London, you would have seen a rather miserable little town, little more than a jumped-up village with appalling hygiene and the most atrocious life expectancy. You know, average life expectancy at birth in medieval London was 32 if you're optimistic about the figures. So, something incredible happened after around 1490, which led European societies to dominate the world through conquest, through colonization, through commerce, through a whole extraordinary complex of processes. The societies of Western Europe, and especially Northwestern Europe, ended up essentially dominating the world, so that by 1900, this still relatively small proportion of the world's population were completely dominant economically and politically and indeed culturally. And that process of conquest and colonization produced in the United States the most successful economy, and many people would say the most successful democracy that history has seen. So, is this the end after 500 years of Western ascendancy? That's the question I've been throwing at my students at Harvard this semester. It's the question that is also going to form the subject of the book I'm writing, The West and the Rest, and the television series that I hope will be the sequel to The Ascent of Money on PBS and on Channel 13. I suspect that this is one of history's great turning points, Michael. I think this is one of those moments when history speeds up. We saw that happen in 1989 when the Soviet Empire collapsed in the space of 2 years with astonishing speed. Now it's kind of happening to us. Let me illustrate what I mean. For more than 100 years, the US economy has been the biggest in the world, and really no competitor has got close. The Soviets were deluding themselves that they would ever catch up with the United States. But if Jim O'Neill at Goldman Sachs is right, by 2027, the gross domestic product of China will be equal to that of the United States. And that could happen even sooner if we see a continuation of lousy low growth in the United States, like we have right now, and continuing nearly 10% per annum growth in China. So this is really a pretty seismic change. For the first time, there's going to be a real equal to the United States. And that's not the only thing that's changing right now. The thing that really most impresses me when I look at the West, what after all do we mean by the West? We mean a whole complex of different countries. You know, I remember having an argument with one of my colleagues about whether Latin America was part of the West, which he questioned. Though for me, it's crazy to argue any other way, both in terms of geography and in terms of the way these societies were created by European settlement. Let's make a clear distinction then between the West, that is to say Europe, and the societies shaped by European colonization, and the rest. By the rest, I'm going to mean Asia, I'm going to mean the Islamic world centered around the Middle East, and I'm going to mean Africa. Now, it's very clear that Africa is going to stay bottom of the heap for the foreseeable future. The projections are grim indeed. Continued population growth, but no really sustained economic growth. The Malthusian nightmare for many African societies. Not all, there are some exceptions, but on the whole, the sub-Saharan story in particular is a pretty bleak one. So, no challenge there. What about the Middle East? Well, the Middle East, if you want to draw the line very broadly, the greater Middle East embracing the majority of great Islamic societies, there too there's no great sign of sustained economic challenge, is there? Most of the prosperity of Muslim countries seems still to derive from natural resources, and those that don't have them, generally speaking, are pretty poor. Which just leaves Asia, more broadly defined, and China and India in particular. Those are the countries which are posing the really serious challenge to Western dominance. And if it's China's race to win, then the world is going to change in a very profound way, because the Chinese think very differently from the way that Westerners do, and their model of both political and economic order is very different indeed. A world in which China is the equal of the United States is going to be a very different world from the world we got rather used to, in which the United States is the hyperpower, the dominant power. Is there anything much to be done about this? That's the question. And I'd say the answer is this: we need to remember our strengths. We need to remember what it was that made the West ascend. If you think about the key killer applications that made Western societies so much more successful than anybody else's from around 1500, well, what were they? Well, there was free market capitalism based on autonomous competing firms with the profit motive. That's number one. Number two, scientific revolution, the pursuit of scientific knowledge in a systematic way, unimpeded by the power of church or the power of the state. Number three, a particular political order based on individual freedom and property rights. The great John Locke saw the importance of this relationship between private property and individual freedom, and that system of law, of common law, on which English-speaking societies in particular arose, that's really the foundation for successful democracy. So those are the strengths, it seems to me, that we really need to remind ourselves of. And we need to make sure that we're not doing things now that weaken those things, that we're not doing things now that actually weaken the capitalist economy, reduce competition. And we're not doing things now that limit scientific research, actually divert resources into research in other countries. And we need to look very carefully at the things we do that might, in fact, undermine the health of our democracy. I see in the aftermath of this crisis all kinds of threats to these killer applications of Western civilization. I worry a lot about the reduction of competition in our economy with the rise of too-big-to-fail banks. And I worry a lot, too, about the way in which excessively powerful economic lobbies and vested interests can call the shots in Washington and indeed in London. Let me turn now to what is just coming in. I'm just going to take a look at the latest, and here we have a longish question from Sherry. Will regulators who are lower paid, likely less educated, and often broadly trained, rarely the cream of the crop, ever be able to effectively regulate the highly educated, market-focused and much better paid bankers who are indeed the cream of the crop? Also, what will be an effective remedy for rating agencies and financial institutions who grade their competitors, driving market movements in stocks and industries? How can independence be established? Sherry, these are fabulous questions. They go right to the heart of the big, big problem of regulation, which I can actually sum up in Latin. Quis custodiet ipsos custodes. I bet that's the first time there's been Latin used in a webinar. Who guards the guards? Who regulates the regulators? That's a really important question. It's not just that regulators are less well paid than executives at investment banks. It's also the problem that regulators are themselves subject to some supervision and indeed are authorised by and governed by Congress. And so there's a fundamental problem which I think is even more serious than the one that you identify. There were regulators. They were not stupid people. They may not have been paid as well as the investment bankers, but they were not people who lacked intelligence. What they lacked was any real sense that they should be vigilantly scrutinising the balance sheets of banks, that they should be vigilantly scrutinising the way that mortgages were being sold by mortgage brokers in Nevada, in Arizona, in California, and so on. So I think we need, above all else, clear leadership from the top. And that, of course, raises the question of who is, in fact, at the top of the regulatory pyramid. There's a big debate going on now about who should really be in charge. Should there be some new super regulator responsible for systemic risk? Or should we go back to the days when central banks took responsibility for something other than just expectations of core consumer price inflation, when they actually played a supervisory role, when they were supposed to manage by a combination of sticks and carrots the behaviour of private sector bankers? As a financial historian, I'm always struck when I look back at the 19th century by the way in which the Bank of England was able to intimidate the players in the City of London, the Barings, the Rothschilds, later the Warburgs. These banks really could not pick a fight with the Bank of England and expect to win. And I think we need to restore the authority of central banks. We need to make it clear that they're something more than just committees for setting interest rates, that they exist to regulate the financial system as a whole, that is their responsibility, and it is a calling to be responsible for systemic risk. You know, I never cease to be impressed by Paul Volcker every time I meet him or hear him speak or read him write, because Paul embodies the kind of public service ethos that is more powerful in the final analysis than the amount of money that people are paid. I'm sure that Paul Volcker, compared with the people who run the investment banks and the commercial banks, is not a wealthy man. He's devoted most of his career to public service. When he ran the Fed, it was much more than just an organization for setting interest rates. It was a formidable organization with a formidable man in charge of it. And he was able to crack the whip and bring inflation down under control, and also, I think, to bring some order to what had become a rather demoralized financial market. So it seems to me it's the ethos of public service and a sense of real passion for regulation. You know, we have to believe in regulation. We can't subscribe to the fiction that markets will regulate themselves. That was an idea that took hold in defiance of all historical evidence, in defiance even of the theoretical writing of Adam Smith, who points out in The Wealth of Nations that people in the same trade will always be trying to conspire against the public if you don't keep a vigilant eye on them. You ask a question also about the role of the rating agencies. Now, I think the rating agencies got into a rather invidious position where their ratings were being used by bank regulators on the basis of the Basel II system to define bank capital adequacy, because banks were allowed to maintain assets according to risk weightings. Now, if you could risk weight the assets, you could really have a lot on your balance sheet for a relatively small amount of capital. And if you could get things that yielded a little bit more than US Treasuries to have a AAA rating, then you were really away to the races. And that, of course, I think was the incentive that led to this proliferation of AAA-rated toxic waste. It's partly the way in which ratings were being used, I think. And there's also, I think, a conflict of interests. If you are producing a collateralized debt obligation and you then go to Moody's or S&P and pay them to rate it, don't be surprised if the competition is to see who gives it a AAA, because, of course, they're the ones who'll get your business next time around. I think we need to look very hard at that system and the conflict of interest that is there. I must say, it disappoints me that this issue of rating agencies hasn't been discussed more. I expect to hear more about it from the administration, but every time the subject of financial regulation comes up, it's conspicuous by its absence, rather like the question of breaking up the too-big-to-fail institutions. That doesn't seem to get much airtime in Washington these days. I'm going to take a little scroll down. I don't want to discriminate against the people who sent in questions just in the past day. Jack, why not abolish the Federal Reserve? I guess that's the Ron Paul question, since he's been campaigning for the abolition of the Fed for some years now, and is, if anything, as close as he's ever going to get to having that question seriously discussed. Well, you could make the argument the Fed hasn't been a rip-roaring success, couldn't you? After all, the Great Depression happened on the Fed's watch. Go back to the time before the Fed existed, and it didn't exist before the First World War. And yeah, there were plenty of financial crises, but they certainly didn't produce anything remotely like the Great Depression. Think of 1907. No Fed, financial crisis comes along, but the Wall Street bankers sorted out with J.P. Morgan sitting in the chair and organizing a kind of whip round of the major Wall Street players to stabilize the markets. So there is now quite a well-established argument that the US is actually worse off with a central bank than it was before. Well, I don't buy this argument. I don't buy the argument that you can have a modern economy without a central bank. And one reason I don't buy it is that I don't have a rose-tinted view of American history before 1914. Financial crises were regular. Bank panics were routine. Currency instability was more or less standard. For the entirety of the 19th century, there was great instability. And the United States was a frontier market in those days. There were states defaulting, banks failing left, right and centre, a financial crisis at least once a decade. And that's one reason the Fed came into existence. A very intelligent man named Paul Warburg. Paul Warburg was his name when he was born in Hamburg, but he migrated to the United States and became a partner at the great Wall Street firm of Kuhn Loeb. And Warburg was one of those who said, look, this is nuts. We can't have the biggest economy in the world without a central bank because it leads to volatility and instability. And the design of the Fed owes a great deal, in fact, to Paul Warburg. And my feeling is that when we look at the Fed's mistakes, they owe much more to errors of judgment or fundamental flaws in monetary theory than to the institution itself. It's often argued that if the right man had been there in the job at the Federal Reserve Bank of New York in 1929, when the Depression struck, things might have gone better. That's the argument that Milton Friedman and Anna Schwartz make in their wonderful Monetary History of the United States, a book that any serious investor should have read. I'm always shocked when I ask audiences how many people have read Friedman and Schwartz, and by and large, it's 1 in 100, maybe 2. So, the Fed is, I think, a fact of life, the way that central banks are a fact of life everywhere. There has to be a reason why there are central banks in all major economies, and the reason is very clear. They perform a number of valuable functions. Lender of last resort, very important in avoiding really systemic crises that explode out of control. And, of course, guarantor of the soundness of the currency. Maintainer of international reserves for the kind of trade that we do with the rest of the world. Well, for those 3 reasons alone, I don't think we can get rid of the Fed. No, let's keep the Fed, but let's try to improve the basis on which it makes monetary policy. Can we please, please, please get rid of what I call the Jackson Hole consensus, that the Fed doesn't need to worry about anything except consumer prices, that in the end, asset price bubbles are not its problem, until that is, of course, they burst. Time for, I think, a couple more questions, and forgive me, all of those whose questions I haven't answered. I haven't actually counted up how many questions there are, but it looks dauntingly close to 200. Let me see. We've got some questions here. There used to be usury laws, asks C. Byrne, Mr. Byrne or Miss Byrne. But credit cards have in recent years charged over 20% under certain circumstances. Well, actually, under most circumstances. Isn't the consumer protected by usury laws from excessive rates of interest? Well, that's a really, really interesting question. You're right. There used to be laws against excessive rates of interest in their original form. In the medieval period, usury laws were designed to prohibit interest altogether. And in Islamic finance today, there are still prohibitions on collecting interest, which means that if you make a loan under that kind of system, you have to get compensation for lending the money in some other way, usually in the form of a commission of some sort. But we got rid of those laws and we've removed really all the last limits on interest rates that survived from the period of the Depression and the World War, except for some remnants in legislation that prevent loan sharks from charging 1,000,000%. And I came across a case of somebody, when I was researching the Ascent of money, who actually was charging, I think, from memory, 11,000,000% by charging people absurd amounts on a weekly basis. The annual rate, the annual percentage rate turned out to, in fact, be 11,000,000%. So there are still laws against that. There are still laws against that kind of thing. But 20%, well, that is a really interesting phenomenon, isn't it? The credit card has been a fantastic money spinner for the people that invented it, because a very large number of people do not understand that a 20 or 25% annual percentage rate is a usurious interest rate. And instead of paying off their credit card debts every month and avoiding being penalized by interest charges, they let the debt mount up. And that is just a fatal way of managing your personal finances. As anybody with even the most elementary arithmetical knowledge knows, if you've got a debt that is costing you 20% per annum or more, and you just let it sit there, and in fact you allow the interest to accumulate and the debt to grow, the laws of compound interest mean that you will very, very quickly be in deep, deep trouble. So it seems to me that what we need here is not so much a return to the anti-usury laws and a prohibition on credit cards being 25%. What we need is some financial education here. We need to get it so that when people leave high school and are about to acquire financial responsibilities, they know what compound interest is, and they know the difference between 25% and 2.5% per annum. If there's one thing that I could blame above all other things for this crisis, it is ignorance, an inadequate knowledge of financial history, an inadequate grasp of basic financial concepts like the real interest rate. These are the things that really have got us into the mess that we've got into. Could we do something about that, please, at the high school level? And please, could we also have more courses in financial history at business schools and universities? Okay, I'm going to take one more question. Before my voice completely gives out, I must admit it's really quite challenging to conduct a conversation with a camera, which is essentially what I'm doing, and nothing but a laptop for company. Hi, Dr. Ferguson, says Brian Craig. Could you please comment on the status of the US dollar as the world's reserve currency? Do you see it being replaced? Well, I'm happy to comment on that. Yes, is the answer. I do see it's being replaced, but these things take time. The pound sterling, the British currency, was the world's #1 currency for most of the 19th century and into the 20th century. And it only gradually began to lose that status after 1931, when the pound went off the gold standard. But it's slow. It's a very slow process. It was $4.86 to the pound in the heyday of sterling, when sterling was currency #1. By the mid-1980s, it got very close to parity, very close to $1 per pound. But that's quite a long time. It's a 50-year slide, punctuated by periodic devaluation crises. 1949, 1967, when I was all of 3 years old, that was a famous devaluation. I think the American experience could be rather similar. Over a period of decades, I think that's really the key point, Brian, not over a period of weeks, months or years, your reserve currency status slips away from you. It's path dependent, as the economists say. It's slow because there's history. We're used to using dollars in international trade. We're used to having dollars in central bank reserves. But it changes. It changes if the government pursues fiscally reckless policies and the central bank finances debt by printing money. It's bound to change. And we can see that already. Look at the way the Chinese are conducting more and more trade with, say, Latin America and other Asian countries, not in dollars, but in their own currency or in their trading partners' currency. Big deal recently between China and Brazil to precisely that end. And look, too, at the rumours that continually swirl around the oil market. Could it be that one day the major oil producers will switch to pricing oil in euros or some basket of currencies like the IMF's, the International Monetary Fund's special drawing right? Finally, look at the way central banks are changing their reserves. You know, the days when dollars accounted for 70% of all central bank reserves worldwide are definitely coming to an end. And if you look at recent changes in reserves, there's been a marked shift in the direction of other currencies. And also, let's not forget, you can have things other than currency in your central bank reserves. What about gold? Interesting episode was the Indian government's decision to buy a bunch of gold that was being released onto the market by the IMF. So we are living through a gradual shift away from the days when the dollar was the world's #1 currency. And we shouldn't be surprised by that, because nothing lasts forever. Once upon a time, it was the currency of the Habsburg Empire of Spain that was the world's #1 currency. These things may take decades to change, but the one thing that you learn from financial history is to think in decades and even to think in centuries. To all of you who have sent me questions, thank you. To those of you who have patiently listened to my attempts to answer them, thank you even more. To those of you whose questions I didn't get to, apologies, there are only so many minutes in the hour. And with this final thought, I shall leave you. We are living through a time of extraordinary financial historical change. Things will not be the same in the future as they've been in our past lives. And whether it's in the role that banks play, the role that central banks play, the role that currencies like the US dollar play, in the balance of power in the world itself, we are living through an extraordinary time of change. And it seems to me that the only way of preparing yourself for an uncertain future is to think seriously about the financial past. And with that, I'll thank you all very much and say good night.